Hey friends, welcome to the party. Aha, here we go. Austin, hello, can you hear me? You can, okay. You seem to be on mute. Austin, hello, can you hear me?
I can. Can you hear me?
Ah, fantastic, yes. This is working. Welcome to the party. Just gonna do some last minute prep on my end, sorting out scenes. You can still hear me, presumably like right now?
Yep.
Fantastic, and I can hear you, and now we'll have a third scene. That's both of us. Perfect. Good stuff.
How's the audio quality on my end, Ollie?
It sounds AirPoddy rather than microphony, but that's fine. Have you got a microphone?
Should be. Yeah.
Oh,
I've got it.
oh, that sounds much better when you're closer to it.
Okay. Is that better?
Oh, so much better. Fantastic. That sounds absolutely beautiful.
Good. Good.
All right. Hello, everyone. Welcome to this episode of The Deep Dive featuring Austin Lieberman. Austin, thank you very much for joining us.
Thanks for having me. I'm a huge fan of yours and a little bit of like stardom here to even have an opportunity to be on your show. You've made a big difference in my life. You've also cost me a lot of money because I've bought a lot of things. I have a 5-year subscription to
Rome.
Rome
Nice.
Research and Notion and all these things. But seriously, Ollie, I look up to the way that you just like hold yourself and present yourself online, the quality of your work, and the passion that you have for teaching people. So I'm really happy to be here.
Oh, well, thank you very much. That's very kind of you to say. So we connected on Twitter when you saw a video that I put out about how to get started with investing. And in that video, I was very anti picking individual stocks and very pro, hey, index funds all the way, screw the individual stocks. But then
Yeah.
as I was saying to you, like I've been interested in the idea of individual stock investing. And so you're like the expert on that front. I wonder if you can just tell us a little bit about your background and kind of how we got here.
Yeah, sure. So I want to start by saying index funds. I watched your video, obviously, and I agreed with pretty much everything you say in that video. And index funds are an awesome option for anybody. The one piece of that video that I disagree with were some of the things around individual stocks. And I'm not adamantly against anything that you said, but what I've learned over, a period of 9 years now, basically, is just that finding great companies and owning pieces of great businesses isn't as complicated as it seems to begin with. And my son is here. You want to say hey, Wesley, real quick?
Oh, hey. Hello.
Okay, you can go open it, buddy. Okay, I'll come out. Yeah, I'll come out when I'm done. Sorry about that. This is
All right.
COVID world.
That's all good.
So anyways, I want to start by saying index funds are awesome. They're a great way to build wealth, and you can almost, based off the history of the U.S. stock market, you can almost guarantee that you'll become a millionaire over time by investing enough money in index funds over a 20 or 30-year period. But we can do really well by investing in individual companies if we go about it the right way. So my history is I graduated college in 2011. Really had no exposure to investing growing up. We didn't struggle. My parents, both had jobs. We didn't have money for extra stuff all the time. I remember times, and mom, dad, if you watch this, don't be mad at me. I respect my parents a lot. We never talked about money, though. It was like a pride thing, right? And we didn't have excess. But I do remember times riding my dad's car and running out of gas, because sometimes that was because he didn't have the extra money, because maybe he spent it on something else and just, didn't budget, or just wasn't super organized and didn't put gas in the car, So I didn't have that exposure growing up. My grandfather was kind of a entrepreneur and businessman, so I learned a little bit about business that way. And I do remember going into his office sometimes and seeing newspapers with stocks and stuff, but like never learned about it. fast forward to college years, I started college on a 50% baseball scholarship to a private school out of state. And after the first semester, realized just the type of debt that was going to put my parents into. So decided to go away from that and move back home, go to community college. I started Air Force ROTC in college.
What does that mean?
So that's Air Force Reserve Officer Training Corps.
Okay.
That's basically the training program in public and private colleges in the United States where you can commission as an officer in the military once you graduate if you finish that program. I did that, and I mentioned that because it's sort of just like my path, right? And so did that for 4 years, graduated, and my senior year of college, and this is where it all ties in, right? My senior year of college, when they know that you're going to commission into the Air Force or the military, you can get a $25,000 loan. It was for like a 3% interest rate or something like that. And the idea is that you use that to like get your life started and help pay for your first move and stuff like that. I spent like some of it on an engagement ring for my now wife. I bought some road bikes. I bought one for me and one for her. She graduated a year before. She's a nurse, so I definitely appreciate the studying and the your somewhat shortened career, I think, in the medical field due to your YouTube fame. But and then I went on a cruise, and I had about like $12,000 left over after paying for a bunch of things I didn't need and a few things that I did need. And my first exposure to investing, and I say that with air quotes, was I watched CNBC and I watched Jim Cramer, and he was talking about, whatever stocks that day. And I ended up putting, it was around $8,000 into like AT&T stock, something I had, the volatility index, which I had no understanding of what it was. And then one other stock that I had really no clue about. And I lost like 50%. I thought the stock market was a ripoff. It was all gambling and stuff like that. So fast forward a little bit, I made it to my first Air Force assignment, and I was working with somebody that was a mentor to me, and they were kind of just at the computer looking at their investments. And he just was talking about how he had turned, $6,000 into like $90,000 over a period of a few years, which is not common. That's not common at all. That's not guaranteed. But he owned Netflix, and he had bought Netflix and held the shares long term, and it literally changed his life. And so through that, I was really interested. And then so we're talking about 2013 now, that started my journey into the possibilities with investing. And it's changed my life. It's helped me with my transition out of the military. It's helped me, it's helped me get to where I am career wise. And if I have to pause for a second, because you might hear my kids screaming, do you hear them yelling?
Yes, a little bit, but it adds to the color of the whole thing. Is everything all right? If you need to take a break, then that's totally cool.
Just give me like 10 seconds so that your fans can understand. So that brings us to where I was exposed to investing and began being interested in individual stocks. But I will be right back.
Certainly. Let's have a look through questions in the chat in the meantime. So, buy Bitcoin, right? Bitcoins. Super chat from John Paul Ruttam. I'm fortunate to have a 6-figure investment portfolio at age 19 where I invest in US and Canadian equities. Going forward into 2021, any advice? Okay, that's a question for Austin. So, any advice from John Ruttan? 6-fig, age 19. What does your portfolio look like at the moment? Are we talking index funds? Are we talking like, specific stocks? Right, let's see what else is going on in the chat. Amazing content, love from Indonesia. Thank you, Tech Mastery. How can we invest if we're not from the States? You Google how to invest and you put your country in and it'll tell you. And yeah, guys, keep the questions coming. We're collating the relevant questions from the chat, and so we will be doing that. And Angus, if you can collate them into somewhere where maybe like a random Notion page, if you can link it to me in Slack, please, that would be wunderbar. Let's see, any advice about growing money from £200? Yeah, invest. Paul Rodet says, "You're my idol, Ali. I hope I ever meet you." Fantastic. Thank you very much. Very kind. Inesh, love from Nepal. Love to you too. I know nothing about investing. I don't even have money to invest, but I'm very interested, Ali Abdal. Well, fantastic. Never too late and it's never too early to get knowledge about this sort of stuff. Time in the market is better than timing the market. So very true. What should I invest in to get money quick? There's no such thing. You can't get money quick. If you want to get money quick, you find a job, and that'll give you money quick. But don't try and invest to make a quick buck. Oh, amazing. Thank you, Angus. Let's stick this on the side. And Angus, if you can add the name of the person as well who's asked the thing, please, that would be very helpful. Hey, Austin.
Can you hear me?
Oh, sorry, I can hear you now. Wait, were you say something? Hello, can you hear me?
Hello.
Oh, perfect. Okay, it's working. Just checking settings on my end to make sure it's all good. Fantastic. Everything sorted with the kids for the time being.
I lost my sound somehow.
Oh, hello. Can you hear me? Testing. 1, 2, 3, 4. Somewhere over the rainbow, way up high, there's a land that I heard of once in a lullaby. Somewhere over the rainbow, skies are blue, where the dreams that you dare to dream really do come true. Cryptocurrencies, quick money. Any books about investments / courses? Good question.
Can you hear me, Ollie?
Oh, I can hear you. Can you hear me now?
Yes, I got you. I'm so sorry about that. I hope people are still watching this.
No, people are still watching this. It's all good.
They were fighting over Legos, but now one of them's watching Frozen, and then my son is building his Legos. All right.
Cool. So we got to your you left the military, and then what was the deal with your background at the Motley Fool? And what is the Motley Fool for people who don't know what it is?
Yeah. So while I was in the military, you're busy. Obviously, it's a full-time job, but you do have time for hobbies and stuff. And at that point, investing was a hobby. And I was a subscriber to the Motley Fool in the beginning of my investing journey. And that was how I sort of got my first exposure to the idea of investing long-term in stocks. And then just as I got more interested in the topic, the best way that I learn is by kind of just applying things and then diving in and trying to apply it to my life. And so they have some freelance type positions. I applied for one and then did a little bit of just freelance work for them over a period of about 3 years. And what they are is they have a kind of a free side to their website, which if you go to fool.com, that's where you'll see all kinds of articles, 10 reasons why this stock is up today and that stock's down or whatever, which I'm not a huge fan of a lot of types of articles like that, just because I'm sure we'll get into this, but they feed the idea of, having to be overactive and find the stock that's going up today or sell the one that's going down today or whatever. And that type of behavior is very damaging to long-term returns, which is, as you pointed out, one of the challenges with people owning individual stocks is it can be tempting to sort of just chase short-term profits. But the Motley Fool also has a paid side of the website with paid subscriptions and stuff like that. I did that for a little while before eventually joining the team at 7 Investing, which is where I'm at now.
Okay. And what does 7 Investing do?
Yeah, so 7 Investing is a subscription service where we first have a lot of free content. On the website, there's a lot of free stuff. We have a lot of stuff that we try to keep oriented towards long-term investing. We have a podcast as well and a YouTube channel. You could just Google 7 Investing or look on Twitter at 7 Investing and we're there. But we also have a subscription service, and it costs $17 a month. And for that, we have 7 lead advisors, and we all focus on different industries. We have somebody in genomics, and that covers the pharmacy sector. We have people. I cover cloud computing and technology companies. We have some people that specialize in like the medical industry, and then people that focus on AI and machine learning. Just different types of industries that we're all experienced in and interested in. And then each month, each of us, the 7 of us, recommend our best idea in the stock market that month for long-term shareholders or long-term holdings to our members. And that costs $17 a month.
Okay. And so you've got some interesting like track record stats. How do you describe your track record with like individual stocks?
Yeah. So one of the things that I tried to do for a long time, and if you look through my Twitter feed, I even had an email newsletter for a while, was be transparent with what I was doing with my individual portfolio, the transactions I had, the companies I owned, and the performance. One of the beefs as a consumer of investment information, or somebody that wanted investment information I had, and I still have, is it's hard to know if you can believe the people that are out there putting information out, right? Because it's not a lot of people share their track record and their performance transparently. And we've seen a lot of, frauds and things like that. So for a long time on Twitter, I shared my individual holdings, my portfolio value, the size, the performance, and exactly what I was doing.
Okay.
I have significantly outperformed the S&P 500 or the market. I don't share my personal stuff anymore because I own the companies that I recommend for 7 Investing, and our members are paying us for those companies. So if I were to continue sharing my own personal holdings every month, I'm giving away what people are paying for. But we do track, and if you go to the recommendations page on our website, we do transparently track the performance of our whole scorecard versus the S&P 500, as well as each individual advisor. I'm happy to talk about that, but I also don't want to come off as like salesy here. But transparency is super important to me.
Interesting. So yeah, I'm a big fan of transparency as well, and I've been I've been toying with the idea that, hey, it would be cool to do videos maybe once a year or once every 6 months where I give an update on what my portfolio is looking like. And at the moment, it would be very boring because it's like, guys, S&P 500. And that's it. Which is, it's a video you can make once or twice, but it's not a video you can make twice a year for the rest of your life. I've been partly intrigued by the idea of individual stocks because then they make for more interesting content. Hypothetically, for example, if I was getting stock tips off of your website, off the paid service, and then I was sharing my portfolio, that wouldn't be an issue, would it? Because theoretically, people would be able to somewhat reverse engineer to an extent.
Yeah. So the only thing we ask is just that people, for one, we would love for you to use our website, Ollie. If you use our service, that would be amazing. But 2, the only thing we ask is just that people don't directly say, hey, I own this company, it's a 7 Investing recommendation, and here's why they recommended it, because we issue full reports and everything like that. But we fully realize like Twitter, YouTube, podcasts are a super powerful tool, and the best type of marketing is word of mouth marketing, right? So like we absolutely love it when our members are out there on Twitter sharing that they're members and that they've been successful and blah, blah, blah. And then naturally they, of course, talk about the companies they own. The only thing we ask is just that people don't say, hey, this is a 7 Investing recommendation. And the reason we ask that is just because people pay for that information.
Sure. So let's say someone is watching this right now and is not going to become a member of 7 Investing and is intrigued by the idea of individual stocks. The traditional advice on this front would be forget about it because there's no way you can compete with actual analysts on Wall Street. Therefore, just go with index funds. Is that also the line that you would take, or is there is there some way of average Joe on the street watching this chat to actually be able to feasibly pick individual stocks in a way that theoretically outperforms the market?
Yes. So, question for you, Ollie. Is the sound still okay? Sound quality?
Oh yeah, it's perfect. Yeah.
Okay. Yes. So I'm here to tell you, you don't have to subscribe to Seven Investing or to any service. It is 100% possible to absorb free content out there and learn yourself and apply this stuff and significantly outperform the market. And I hope that people do that. And it's the same thing that probably your same approach to business too, right? Like you put out a ton of free, amazing content that teaches people to have more productive lives and be organized and make more money, have their, grow a YouTube channel, but you also have paid courses, right?
Yeah.
And paid opportunities. And I view it the same way. Your paid courses are, everything is bundled nicely together. You walk people through step by step. You share exactly, 100% like your thoughts, your process, everything like that. That's our view on our paid service at Seven Investing. And so my advice for people that are interested in owning individual stocks that maybe don't have the money or don't just want to pay for a service is to really just begin reading widely, right? And take that back. It all starts with the foundation of your personal finances. And so from the beginning, this is going to sound kind of boring, but and this is on the free side of our website, but I'm just talking about me personally. I do not invest, and I never did invest any money that I need potentially in the next 3 to 5 years.
Yeah.
I also, when I invest in a company, I want to own it for 3 to 5 years. And then I tried to look, when I buy shares of a stock, I look at that as owning part of the business. If you have that mindset, you have to have that mindset, in my opinion, to be successful owning index funds or owning individual stocks. And so if we start from there and then move to the next step, which is, okay, we get that. We've invested in index funds. We understand, you've watched Ollie's video and you understand kind of the things you talk about. What is an investment? What are shares? How do you buy shares? Like you understand all that stuff. Then we move to, all right, I want to own individual stocks. There's a couple great resources and books that I'm happy to share. And I don't have any affiliation with them at all. But I mean, you mentioned Graham Stephan, Andre Jick, Mr. Money Mustache, a couple of those. Those are great like index fund type of resources. But a completely free resource is a website called Common Stock. It's a platform where you can, all of it's free. You can sign up for free and you can go there and you can see investors on the platform. And it's similar to Twitter where people can be out there talking about stocks, right? But the cool thing about Common Stock is that there's investors that can link their portfolios, and all of that information is shared publicly. So you can see what they own, you can see what their performance is, and you can see the stocks that they talk about in their different types of memos. A platform like that is fantastic because it sort of solves that problem that I talked about where there's a lack of transparency and accountability for people that talk about stocks, right? Common Stock is really the first platform I've seen that takes care of that accountability problem for people that are out there talking publicly. There's of course a chance that somebody's not being truthful or somehow tricking the system or something like that, but it helps eliminate a lot of those problems that you see on other platforms. But I'm also happy to talk through, like, I want to make this as valuable as possible. So if you want to talk about a potential checklist that people could use to identify potential good companies, and then we could even research a company together for the audience, like whatever you want to do. I'm happy to walk through that process as well. Like, what does a research process look like for a company?
Yeah. So I think I'm just trying to think, like, what are the questions that I actually personally have about this? Okay, so surely it can't just be that simple, right? Like, surely you can't just go on like fool.com or on 7 Investing and then just copy someone's portfolio that they recommend and outperform the market. Like, surely there is more nuance than that. And surely this is all, skewed by the fact that the market has been doing very well since 2008. And so, like, how do you, yeah, it's just, given that, I think for me, I have a huge bias against individual stocks and towards index funds because the only type of content I've consumed around it for the last 5 years since I started investing has been so anti-stocks and so pro-index funds.
Yeah.
So what are like what would be some compelling reasons not to go for individual stocks?
That it does require time to learn about what companies have been successful in the past, what made them successful, what can we pull from the history of a company like Amazon or Apple or Netflix or Starbucks to start to understand the traits of successful companies that you could then apply and create a checklist. And there's all kinds of checklists out there. I'm again happy to share like exactly the types of things and the numbers that I look for. But there's a million checklists out there, and there's a million different things. It requires time, and it is risky to invest in individual companies. So there is a chance of losing your money, but there's a chance of losing your money technically in index funds as well. And the other challenging part is that you have to have the right behavior. If we are thinking about buying and selling companies on a monthly basis or holding for a few weeks or even a quarter or a year, you're likely to, over the long term, underperform and lose money. If you have a mindset of when you buy shares of a company, you are literally becoming a small part owner of that company and you want to hold on to it for 3 to 5 years, then you begin to set yourself up to be successful.
Okay. Interesting. Why is it that, again, I may be wrong about this, but like the traditional pro-index fund people would say that actively managed funds, it's sort of in the long term don't really beat the market because let's say one fund does really well in 1 year, then the next year it doesn't, and then allegedly there is very little correlation between sort of a fund that does well in year 1 versus a fund that does well in year 3 or 4 or 5. If that assertion is true, and people who actively manage funds, i.e., whose job it is to invest in companies, if they can't manage it, then how can sort of people like you who don't like work on Wall Street, presumably, or like the average Joe on the street who's researching companies, how can we possibly hope to outperform the market when trained professionals can't do it?
Yeah, so I think there's a lot of things in there that are actually advantages to people like you and me who aren't professional money managers.
Okay.
If you are a fund manager or you have a mutual fund or an actively managed fund, you are regulated by, and I may get some of this stuff wrong because obviously I'm not a fund manager. So if I use the wrong terms here, audience, don't come after me. But basically, they have rules and regulations that they have to follow that are set by either the company they work for, the SEC, or different regulating bodies that say, because it's this type of mutual fund or this type of actively managed fund, we are only able to have this percent of the portfolio in these types of companies, and this percent in these types of companies, and this percent in these types of companies. We also can only have the maximum of maybe it's 3% or 10% of the portfolio in any single company. They also have to perform well on a monthly basis, a quarterly basis, an annual basis to keep attracting investors and keep people invested. Because a major threat to mutual funds and actively managed funds is if people withdraw a lot of the money invested, then that causes the fund manager to have to turn things over and make sure the money's available. So all of those things cause exactly what I talked about earlier, which is a lot of activity and a lot of turnover. And so, your average mutual fund or actively managed fund has a high turnover rate to where, they're probably turning over every stock in the portfolio either once a year or once every 2 years or something like that, which is exactly what causes underperformance. The 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 time you really make life-changing wealth in the stock market is by owning for decades, right? And so there's, you talked about since 2008, the market has done really well, right? I have a chart pulled up in Y charts that just shows Apple, Amazon, Netflix, Starbucks, and Microsoft. And even, this goes back to 2002, right? And even at that time, like as a kid, it was easy for me to look at those companies and say, you know what? Yeah, Amazon is pretty cool, or Netflix seems like a good idea. I use that. Starbucks, my mom goes there all the time. Microsoft, I use a Microsoft computer at school every day.
Yeah.
If you would have invested $10,000 into each of those companies in 2002, which is a lot of money, but let's say $1,000, right? That would have been, let's see, $5,000. You'd have, literally millions of dollars. So the chart I have shows $10,000. So $10,000 in Netflix in 2002 is worth $4.3 million today. In Apple is worth $3 million. In Amazon is worth 1.6 million. In Starbucks is worth 176,000, and in Microsoft is worth 83,000. And so then the thing is like, well, you wouldn't have held that whole time, or you wouldn't have been able to find those companies in the first place. But that's where it comes into having an approach, right? And so I'm not going to invest my entire portfolio or all of the money I have in 5 companies. But say I have $1,000 to start, I might pick 20 companies and put what is that? $50 in each, which you could do now. So okay, maybe it's $10,000 total, and put $500 into each of those companies, and then you can start with that. And then each month, you just like in an index fund where you continue adding and buying a company you like the next month, and having a portfolio of between 20 and 30 companies. It's not hard to imagine owning, even if you just owned one of those companies over a period of 20 years, your life is changed forever. So the key is just, how do you find them, right?
Yeah.
And then how do you build the behavior of understanding that you don't pay attention to the day to day, and you don't pay attention to the month to month. You pay attention to finding great companies and owning them for the long term. It's all about investor behavior.
Okay. Interesting. So, let's say today. So one thing I always have, which I'm sure everyone does when it comes to the thought of buying individual stocks in a company like Apple or Netflix, it's that, well, all of the gains have already been made. Surely now it's not going to be a radical outperformer like it once was in the past, and surely I've kind of missed the boat.
Yeah. So how long have you kind of like maybe thought that about Amazon or Apple or some of these companies?
At least 5 years. I remember 5 years ago I was thinking I should probably buy some stock as an Apple. Oh, nah, surely not.
Yeah. So let's go back 5 years, right? And I'm not trying to put you on the spot. I do this same thing, right? So 5 years ago, $10,000 invested in Apple is worth $50,000 today. $10,000 invested in Amazon is worth $50,000 today. $10,000 in Netflix is worth $44,000. $10,000 in Starbucks is worth $17,000. $10,000 in Microsoft is $40,000. So the point is, to your earlier point, it's been a very good period in the stock market since 2008, right? Minus March of 2020, which was terrifying for everybody. But I had those same exact feelings about Apple and Amazon and Netflix because they had been up so much. But you mentioned something in your initial video about investing in index funds, where just because a company has done well in the past doesn't mean it's going to do well in the future. There's actually a lot of reasons why companies that have done well in the past very well could and likely will do well in the future. And some of those reasons are these are real businesses, right? And so if it's a bubble and it's something like Nikola, which had no product, no revenue, and it was popular for a year, that's not the type of thing that I invest in at all. But if it's a real company like Apple that has for years has had the number one smartphone, and they've been building this suite of services and subscription services around their iPhone to make the platform more sticky.
Yeah.
Those are very real businesses. So you're taking ownership of a business. When businesses start to do well, they have more revenue that they bring in every month, which they can then invest back in the business to put in research and development, put in marketing, put in hiring great people. So they're going to be able to release more products. They're going to have better products. They're going to attract more people. They're going to be able to hire more people. So there's a lot of reasons why success in business leads to further success. Since if you think about your YouTube channel, right? It's you started out with no following, and then you were consistent. You figured out what works. You gained a viewership. You gained momentum, and then you just kept applying that and making better and better content. And it's probably grown more than you would ever imagine, right? And business is your YouTube channel is a business, right?
Yeah.
It's very similar.
Interesting. Yeah. So I guess applying your approach to investing, you wouldn't have theoretically invested in a pets.com or in like one of these famous stories of things that were bubbles at the time where people are just trying to get in on the hype and sell immediately.
It's possible that I could have, right? So if you go back to 1999 or 2000, and if you, again, the basics for me are don't invest any money that I need in the next 3 to 5 years. Don't use any margin. Don't and invest for the long term and find great businesses. I'm confident that if I owned 20 companies, and we'll say 20 to 25 companies is a good amount of companies for people to own. If I owned 25 companies in 1999 or 2000, it's very likely that I would have owned Amazon, and I would have owned Microsoft, and I probably would have owned pets.com or whatever, a couple of the ones that went to zero too. Yeah. But the most that a stock can go down is 100%.
Yeah.
The upside is unlimited. And so having, one big time winner in your portfolio, and you also have to remember that if you're working and you're contributing to your portfolio every month, just like you would contribute to a 401k, and you're spreading that across great companies, and maybe it's one company a month you buy or two or three, it's not like you're putting your entire life savings into Apple right now or in 1999. You're spreading it out over dollar cost averaging, the same thing as an index fund, over a period of years, right? And so that helps with some of that volatility too. But the point is I probably would have owned some companies that went to zero in 1999, but there's a high likelihood if I was looking for great businesses that I would have owned some that are some of the best winners today.
Nice. Okay. What does your portfolio look like today in terms of individual stocks versus funds? Are you 100% individual stocks, or do you have like a more split?
Yeah, I own 100% individual stocks, and my approach was, while I was in the military, I did a little bit to the TSP, which is like the military retirement stuff. Mm-hmm. But when I was working a full-time job, and this is not advice for anybody, this is just what I did. My wife and I contributed up to the maximum that our employers would match into our employee 401ks. And we just did S&P 500 index fund in those. And then beyond that, what we did, and this worked for us, it's not a recommendation for anybody else, is beyond that, we had an additional just brokerage account that we, was our own, I've always invested in individual stocks. So I'm 100% invested in individual stocks.
Interesting.
And I'm happy to share with you the companies I own. I won't tell you which ones of those are 7 investing recommendations or not. But
that would be interesting. Maybe, like what do you
maybe
own?
Yeah, sure. Maybe that will help. Like, again, I don't want to be shady or anything like that. So, okay, I own a company called Datadog, which does a lot of observability. So they have software that allows companies that have different cloud services. So say they have a website that's hosted by Amazon Web Services or something like that, and a bunch of different services. Datadog allows them to see across a lot of the different software that they have and see how things are running, if there's any red flags or alerts or anything crashing, the health of their applications, basically. I own Fastly, which is a company that does edge computing and a content delivery network. And so what that means is, so cloud computing is this thing where, if you think about Amazon and Amazon Web Services, if you want to start a website and have hosting or have storage and services, you can pay per month for services from Amazon Web Services, and you don't have to have your own server that's at your own location and have all the security and run all that stuff yourself. You're basically outsourcing that to Amazon. Edge computing is basically the next extension beyond cloud computing, which allows applications like Spotify to offer customized music playlists to different customers in one country than it does in another country. So what edge computing does is just moves data closer to where customers are using it, which allows for more customizability, faster response times. Wesley, I'm in a meeting. Okay, buddy?
We have an echo.
Okay, do you want to say hi?
Huh.
All right.
We have an echo.
All right.
You have an Echo.
We have an echo.
Yeah, an Amazon.
Oh, Amazon Echo. I bet you're on Amazon as well. Yeah.
It's an Alexa, which he renamed and calls it Echo.
Nice.
Wesley, can you go to the other one, please? Then close the door. He likes to use the bathroom when I'm in meetings, and we have like 3 other bathrooms in the house. So Fastly has been a company that I've owned for almost 2 years now. Okay. Fiverr is a company that it's like a third party marketplace.
Yes, I'm very familiar with Fiverr. They sponsor tons and tons of YouTubers. They've reached out to me many a time.
Yeah. If you hear anything in the background, let me know. I'll mute it. The thesis with Fiverr, right, is I think that companies more and more are going to need to outsource their development, and there's a lot of creators out there that are doing things and need to hire people. And so I think as COVID has unfortunately changed businesses have had to let a lot of people go. They still need to be able to run, and they need graphic design and websites built and all kinds of different stuff. I think Fiverr is a great platform for that. You might find this interesting. So Nanox Imaging, right? Okay. What they do is they have a revolution. They claim revolutionary X-ray technology, and the idea is that it is an upgrade on the 100-plus-year-old technology that traditional X-ray systems have. So traditional X-ray systems are very large, very expensive. They cost hundreds of thousands of dollars to develop and millions of dollars to buy. Because of that, and this is Nanox's argument, that drives the cost of scans up and makes X-ray imaging unavailable to like 2/3 of the world's population. Okay. So Nanox's model is it uses cold cathode versus hot cathode. So it runs a lot cooler. The system can be a lot smaller, and it's much more portable and much cheaper to develop. They're trying to basically offer X-rays to the 2/3 of the world that can't afford it. And so imagine being able to have X-ray systems in urgent care places or in Africa or different places that would never have the capacity to do it with the current systems. Okay. The thing about Nanox is it's super, 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 super risky. They don't have FDA clearance. They don't have any sales. They have contracted sales, but they don't have any actual sales. So, and this is part of the learning process, right? You have to identify like what makes a company risky and what makes a company a little bit less risky. A company like Amazon, much less risky than a company like Nanox that doesn't have any revenue. And so I believe Nanox has a good future, so I want to own a part of it. But I only have 1% of my entire portfolio in Nanox. I don't have 10% or 20%. And I've accepted that there's a chance I'm going to lose 1% of my portfolio. But through my research, I've decided I like the opportunity because they could potentially grow into an intuitive surgical sized type company which would be, a 50 times return or 100 times return on your money. So I'm willing to risk 1% of my portfolio for that potential upside in Nanox.
Okay.
Happy to keep going.
How many companies do you have in total across the portfolio?
I have right now. I own. I'm looking at it. I don't want to take time. I own around 15 companies.
Oh, okay.
And in a good starting point, like when I started out investing, I wanted to own 25 to 30 companies. And if you think about, so the other thing is like when you invest in companies, how do you allocate your portfolio? Do you put everything in one company?
Yeah.
Do you do it all evenly? And I'm not giving any specific advice to anybody, but this is what I've done in the past. Again, I'm not a financial advisor, so I do not give any individual financial advice. I'm just sharing my experience. There's a couple options. If when I was putting money in every month, and I was in the first, we'll say 5 years of my investing journey, I would split the money that I was putting in my portfolio in half and each month and buy 2 companies every single month. And my goal was to get up to 30 companies and then keep my portfolio. And so I would have invested the same amount into each of those 30 companies. But some are going to do better, some are going to do worse. So they're not going to all stay the exact same size. But my goal was to put the same amount of money in each of 30 companies and then just let them grow on their own. And so I owned Shopify in 2015 for $40 a share, which is now worth $1,200 a share. I don't own Shopify anymore because it went up like 100%, and I sold it, and I thought I was really smart and made 100% return and sold it for $80 a share. What's $1,200 a share today? Which goes back to owning great companies and not being active, right? So I've made a ton of mistakes, and I'm happy to talk about those too, right? So anyways, the approach could be to invest in 2 companies every month, put the same amount in each one, and then let them grow on their own. Or if I had a lump sum of money I was investing right now, I could find 20 companies that I thought were good investments. I probably would not invest it all at once right now. I would probably split that into 4 separate chunks and invest the same amount every 2 or 3 months on a set date. I would not pay attention to what the stock market was doing, if it was up or down. I would say today is December 22nd. I'm going to put my first 25% in, or 1/4 in. Then on February 22nd, I'm going to put my second 1/4 in. Then on April 22nd, I'm going to do the next, and then do it mechanical like that, so that we take a lot of that potential for bad behavior to say, well, the market's down, I'm scared, I don't want to invest. Take that out. Or the market's up and I don't want to invest, and take that out.
Okay. That's very interesting. Okay, I think you've sold me on the idea of investing in individual stocks. So I'll be browsing through the website at some point later this evening. A few more questions. How do you feel about Bitcoin?
I have a mostly hate relationship with Bitcoin. So I owned Bitcoin in 2017 or 2018, which was, I bought it like right at the high back then.
And that was December 2017. I lost a lot of money that month as well.
And so listen, like this is the challenge with investing, right? The same thing, the same challenges, the mental challenges of investing in Bitcoin exist in investing in individual companies, right? Like it was going up and going up and going up. I was like, I gotta buy some. And I did, and then it went down, and then I owned it for a while, and I ended up selling it when it was down like 60%. But again, I invested a small amount of my portfolio. It was like 0.5% of my portfolio, and if I lost it, I lost it. And it was unfortunate, but that was okay, right? So my thoughts on Bitcoin have evolved. I think the issue I have with Bitcoin is not with Bitcoin or cryptocurrency or the blockchain itself. It's around it's with the narrative around it that a lot of people are pushing. If you're out there, you see people saying Bitcoin to 500,000 or Bitcoin to 50,000 or 100,000 or whatever, and they act like it's guaranteed. And people do this with stocks too, and I don't like it when people do this with stocks. We don't know. You can't be certain about what's going to happen. So my thoughts on Bitcoin are, if somebody wants to make it a 1% position in their portfolio or 2% or whatever, a percent that they're willing to lose because they like the potential security it provides to devaluing global currencies and the devaluing the US dollar, then fine, do that. But just don't fall into the trap of thinking, because everyone's out there talking about it, it's guaranteed to go to $100,000 or $500,000 or whatever. I think there's some very real use cases. We see a lot of companies starting to offer it. You see Square offering it on their platform, and I think Venmo and different people are investing in it. So I don't think it's like going away, but you can get trapped in anything, right?
Yeah. How do you feel about leverage when it comes to buying stocks?
If I'm talking to my family members or myself, I tell them never, ever, ever use leverage. The beautiful thing about investing in an index fund or in individual stocks is we showed that example, right, of owning $10,000 of those different companies, or even $1,000 of them over 20 years. You don't have to use leverage to do that. And the most that you can lose if you are not using leverage is 100%, which is not good. But that doesn't happen as often as a lot of people would lead you to believe. It's I don't want to say it's easy to avoid investing in fraudulent.
So unlikely, yeah. That if you actually, yeah.
Right. Like there's always a chance that a company you invest in is going to be fraudulent and you're going to lose 100%. But it's far, far, far less common than the narrative and the kind of the fear mongering out there leads you to believe. And if you own a mixture of 20 to 30 great businesses, it's very unlikely that you're going to have more than one or two in your lifetime, unless you're chasing the hot stock of the month or day. Then you could fall into that trap.
Okay.
So, but if you're using leverage and something like March happens, or a 10% drawdown in the stock market, which happens commonly, then that can absolutely destroy your financial life. If you just own stock with money that's yours, it's totally natural and actually common and healthy for stocks to pull back 10% or 20% or 30%. So I will never, ever, ever tell anybody that I know or care about.
Yep.
I will tell them not to use margin ever. You don't need to do it. It's not worth the risk.
Okay. Do you have any stop losses set for your own stocks? / how often do you check them to decide, oh, this thing is going down, therefore I should sell?
Yeah, great questions. I should just let you ask questions, Ali, and not talk the whole time. I don't use stop losses, and the reason I don't is because I went back to that grouping of stocks, right? And I told you how much Apple and Amazon made over those periods. Well, they've all lost 30% of their value, 5 to 10 times over that 20-year period.
Yeah.
And so if you have stop losses, you're almost guaranteed to sell at that stop loss number, which is lower than the price today. And that just gets to being overactive and buying and selling too much.
So how often do you look at the portfolio and do some twiddling?
Too much, and this is something I'm trying to work on, right? It's like I enjoy it, and it's something that I do on a regular basis as kind of part of my job at 7 Investing. So I look daily at my portfolio. Data shows that the less people look at their portfolio, the better they tend to perform. And so I'm trying to get to a point where I look, maybe weekly or something like that. Will I get there? I don't know. But the more important thing is how active are you, and how long have you owned the stocks in your portfolio? And for that, I try to own them for multiple years.
Okay. When do you decide the time is right to sell a stock?
Yeah, there's a few reasons that I think it makes sense to sell. So we went back to like the fundamentals for me of investing. Don't have any money invested that I might need in 3 to 5 years. So we were moving in a year, and we knew that we were going to probably need some money for a down payment on a house. As soon as we knew that we were moving, I made sure that I had the money for a down payment on a house not invested in the stock market. So that would be a reason to sell, is if you find out, at least for me, if I find out that I'm going to need money in the next 3 to 5 years, I would not have any of that money in the stock market. So that's a very valid reason to sell. Another reason is, and this is as we evolve and learn more about investing in our own comfort levels, we learn the size of position that we're comfortable with a company being in our portfolio.
Yeah.
And so when I was first starting, every company I had, I put the same amount in, and I really wanted to keep them under around 5% of my portfolio would be the maximum I would want any company to be. So when I set that percentage, if a company went to 10% of my total portfolio value, I would sell that down to 5%, to where it only represented 5% of my portfolio. That number is going to be different for everybody, and I'm not recommending a specific number for anybody. But as you know your comfort level and how stressed you are and how well you sleep when you own stocks, if you start to get uncomfortable because Netflix or Shopify is 20% of your life's net worth, probably worth considering selling some of that, right? Yeah. So another reason to sell is to get it back down to the logical size in your portfolio that you want it to be. And then the final reason, and this is where I've messed up the most, is if I think the investment thesis is broken. So this is where or there's a better opportunity. This is where I sold Shopify in 2015 for $80 a share, because I thought that Amazon was threatening Shopify's business model, and I could invest in another company and do better. That last reason is the reason that I'm trying to actually sell a lot less for, because if I'm doing everything else right up front, if I'm invested in 20 to 30 companies at basically even sizes and I let them grow on their own or drop on their own, I can afford for some of them to not do well, and then I want to let the ones that are going to do well continue to do well and not feel pressured to sell them. So the third or fourth reason is if the investment thesis is broken, or I think there's a much better opportunity, but I'm trying to do that a lot less. And so an example would be I used Nanox Imaging as an example of a company I own. If they're unable to get FDA clearance, and they're unable, or they do get it and they're unable to actually sell their systems, that would break the investment thesis that I have for that company. And so at that point, I would strongly consider not owning it anymore.
Okay. And to what extent does Seven Investing give advice to sell stuff rather than just to buy stuff? Yeah.
So we have our scorecard, and all of the companies that we recommend are listed on our recommendations tab, and you can see them. We haven't recommended, we've started the service in March. We have not recommended to sell any, but if the investment thesis is broken, or we think that the company is no longer investable, we will recommend to sell. But again, it all goes back to, so in theory, the model of Seven Investing could be that you invest evenly in either 7 of the recommendations each month, or you pick 3 of us that you like and buy 3 of the stocks, or 2, or do your own research amongst the companies. And invest evenly among them. In theory, we're adding evenly to our stocks monthly, just dollar cost averaging. And we're going to let the winners continue to win, because that's how you find the Amazons and the Shopifys and the Starbuckses and Netflixes of the world, and let the losers lose. And the losers won't matter as your winners outperform in your portfolio. And our scorecard kind of shows that, right? I'm trying to log in here. We have a company on the scorecard that's up 400%. And we also have some that are trailing the market a little bit, but the average return is 61% and that's across all of the companies we've recommended. And that's a pretty good return, right? And so there's winners and losers in there. There's some that are trailing the market, but if you find great companies and some of them outperform, then the outperformance far outweighs the losses.
Okay, interesting. It's like how I suppose, Stripe and Airbnb make up for every single thing that Y Combinator has ever invested in, even if everyone else has lost money.
Yeah, that's a great point.
Okay, interesting. Someone is in the chat, Miss Y, has asked, what's the difference between technical versus fundamental analysis, and what are the pros and cons? I don't know what this means, so yeah.
Yeah. So there's a lot of different ways that people invest slash trade stocks, right? We go for investing. Technical analysis is basically looking at some different software or whatever and seeing the chart of the stock, all these weird lines.
Yeah, lots of my friends tried to do that with Bitcoin in 2017. That, oh my God, the 5-day moving average has dropped by 2%. Therefore, it's time to buy and all that crap.
Yes. Yeah. So technical trading is like trying to identify patterns that I think are made up to know when to buy and sell. And that goes to a lot of that really high turnover. Fundamental investing is kind of what I'm talking about, where I try to find big trends that I think are important, like cloud computing, edge computing, virtual healthcare, connected fitness, e-commerce, and then studying those industries, finding the companies that appear to be leading those industries with, great products and things like that, studying those companies at their investor relations pages, and then buying them because their businesses are performing really well. And I think the business is going to grow and be bigger and more important in the future. That is fundamental investing. You're trying to find great companies to own.
Okay, sweet. Another question from the chat that's come up fairly regularly is, if you were advising someone, or if you were talking to like friends or family in a non-official capacity and having a chat with them, how would you feel about if they said to you, "Hey, I've heard that day trading, you can make a lot of money through day trading"?
People can't. I mean, there are probably people out there that make a lot of money day trading. I know a lot of people that have. I know a few people that have done it and they've been successful. I know a lot of people that have tried it and lost a lot of money. And the thing about it is, I invested for a long time when my full-time job was active duty in the military. And so there was periods of weeks or months where I couldn't look at my portfolio. I had a full-time job, a family. I didn't have time to be sitting in front of a computer all day trading in and out of stocks. Yeah. I wanted to do some research, find great companies, buy them, and then be able to own them for 3 or 5 years because I had a life to live, and I had a job and wanted to make money other ways and then use my investment portfolio for retirement or buying a house or, long-term financial goals. So I like that there's a lot of different things people can do. I don't want to talk down to day traders. I haven't been successful day trading, and I know a lot of people that have not been successful day trading.
Okay, cool. Quick question. All the companies that you invest in, presumably these are all public companies? You don't have special access to random private companies?
Yeah, 100% public companies.
Cool. How do you feel about real estate, like on a personal level?
We own our house. We have a mortgage on it. Yeah. I don't view that as an investment. I view it as utility. We wanted to own the house we live in. I have some friends that are involved in real estate. I've never been interested in real estate because, and this is just my opinion, right? There's a lot that I can't control, like what's going on in the local economy, if the house next door to me is expensive or not, if there's bad neighbors or whatever. I don't want to. So I moved around a lot when I was in the military, and we owned houses. And then every time we moved, we wanted to sell our house, not keep it and rent it out, because I didn't want to have to bother with having a property management company and renters and deal with that.
Yep.
I really like the idea of investing in the stock market, whether it's index funds or individual stocks, doing some research in my spare time or whatever time you have, and being able to invest in a company and let that company grow my money over time. Because I'm kind of lazy, and I don't like having to deal with a lot of the physical labor that would go into real estate.
Okay, yeah, that makes a lot of sense. One thing that I was curious about, like, how has your approach to money changed as you have made more of it? And I ask because as this is happening for me, I'm never quite sure. Like, it just seems to vary a lot.
Yeah. So I want to be clear. Like, I'm by no means out there flaunting as a multi-millionaire or anything like that. I've had I would say mid to later in my military career, I guess it's considered like upper mid income, and then just invested. And then the portfolio, because of compounding, has grown to, and it's amazing what it does is it dwarfs, even my wife and my own combined income each year. And that's just what happens. It's not because I'm great. That's what happens when you invest and you let your money compound. I still try to not we have a 5-year-old and a 3-year-old. I try to not spoil our kids or anything like that. I have noticed myself being much more willing to and able to do things to help our parents. We've had, people have medical issues and things like that. So it's really nice to not have to even think twice about helping your parents or your family with something. It's really nice to. I've subscribed to subscription coffee companies and like Butcher Box and things like that. I still don't want to own an expensive car, right? Because I want to have a functional car and a safe car for my family, but like I see no reason to own a $80,000 or $100,000 car, because if you look at what those monthly payments, if you go to an investment return calculator and look at what $400 a month in the S&P 500 would do at 8% a year for 7 years or however long, you're literally paying hundreds of thousands of dollars for that vehicle, not $80,000. So it's we recently bought a Sleep Number mattress, which I've had lower back issues for a long time because of my military career. I would have never paid $10,000 for a Sleep Number mattress, even though I have back pain every day of my life. Early in my career, where we didn't struggle, but like I was wanting to build up a retirement account and things like that. As we've been fortunate and been lucky in a lot of ways, but also intentionally invested, I'm much more willing to do stuff like that because I realize the impact it's going to have on my health in my life.
Sure.
And the last thing is we've recently started paying for yard service, because for $150 a month, you get back 4 or 5 hours of your time. And time is worth a lot, right? Like when you have kids and stuff. So I've been willing to pay for things that give me more time with my family.
Do you think about it in terms of like, this is my effective hourly rate, or is it more like whatever feels right?
I heard Naval talk about that, right?
Yeah.
Like
that's his shtick.
I'm nowhere near his level. I don't know if I ever will be. I don't think about that at all. I think I just think in terms of, okay, if I pay $140 a month for lawn service, but I get an extra 8 hours with my family, and then I can spend some more time on growing a business or my career or whatever, that's a trade-off that's worth it for me. And then I'm sure you think about it the same way, like with your own business, is what's worth paying for and what's worth what's worth spending your own time on.
Yeah, absolutely. The other factors I use is how much do I enjoy this thing that I'm spending time on rather than outsourcing. This is partly why I've been so hesitant to outsource web development, even though I should, because objectively it doesn't make sense. But it's just kind of fun. It's kind of fun doing a live stream on Twitch and just tinkering with some coding and getting some CSS tips from people in the chat.
I think that's part of your brand too, though, right? Like I've followed you, and I think like outsourcing that, I guess, could save you some time. But I don't know. I connect with you on that because you do it. I don't know if that's common amongst your audience or not. So it's like I don't know.
Okay, yeah, that's interesting, because I do get a lot of questions like, how did you learn to code and all that kind of stuff. I think it feels like an intriguing thing for people who don't know how to do it. It's like, oh, you can code. It sounds like a bigger deal than it actually is. is my kind of skeptical theory on that front.
It's just like authentic, I think, to your brand, but at the same time, like that will stop you from being able to do certain things. So I don't know, maybe you continue to do a small part of it or something like that and outsource.
Yeah. I'm still thinking about that on a few different areas. How do you think about? And again, I'm asking this purely selfishly, but maybe some people will get value from it in the chat. When you get to the point where you have, quote, enough, how do you then think about work and like the making of more money, despite already having enough, already having enough in your, I don't know, portfolio to 4% withdrawal rate and all that kind of stuff. Like when you have enough and you're still striving for more, how do you think about it?
Yeah. So I was in the Air Force on active duty for 7 years before I trained. I'm in the Air National Guard still, so that's like part time, right?
Okay.
And I was planning on doing 20 years in the military. If you do that, then you obviously have a pretty stable career because you're not going to lose your job overnight, and you do get a pension for the rest of your life. At least right now, that could change.
Yep.
I was planning on staying 20 years because I liked it, and it's a relatively secure life, right? I volunteered for a deployment when my son was right after my son was born, and so he was a month old, and I was gone for 7 months, and that was fine, but it was hard, right? I missed Christmas, I missed Valentine's Day, I missed my own birthday, I missed my wife's birthday, I missed our anniversary, all these things, right? And I'm not complaining. People make these sacrifices and far worse all the time. But then I started to see what my career might look like if I were to stay in, because I was getting closer to people that were like senior officers.
Yeah.
And I started to see some of the impacts that had on their families and stuff like that. And there's some that have amazing families. So I'm not saying it's like this terrible thing. It's just choices you make, right? And then I was going to get a non-voluntary 1-year deployment about a month after my daughter was born. And at that point, I said, I want to have other options, and I want to prioritize time with my family, and I want my wife, I want her career to be able to be a priority. And so the reason I was able to make that decision and leave the military was because we had been saving and we had been investing, and we realized that like we have enough, we're secure, and sure, maybe I'm going to this unknown, it might really hurt my income. And if you look at the compounding of what 8% a year or 10% or whatever you think you're going to make in the stock market, it turns into millions of dollars later on if you once you get to a certain size. And so when I was looking at it, I was like, well, that, maybe it's a potential $1 million or $2 million difference 20 or 30 years from now. And that's a lot of money. It's like unimaginable money to me at that time. But if you also do the numbers out, I could see that we were still not bragging or anything like that, just based on compound interest, we would still be really well off and be fine. And so I was able to make that decision of like, hey, money's worth something, but you only get one life, you only get one family. And so I don't know if I'm really answering your question here, but that's what allowed me to make the decision to transition out of the Air Force. And then because of that transition, I now make more money amongst the different things that I do than I made in the Air Force. And I would have never thought that happened, but it's almost like it gives you more, and I'm super privileged to be able to say this, right? But having that gives you more opportunity and the opportunity to take risks and do things. And so I was able to get to the point where it's like, I love what I do and I want to work. Like I probably wouldn't just quit working and never make money another day of my life right now. But I guess you get to the point where it's like, you can do what you want to do, and it's nice to not have to stay in a job or a situation that you have to stay in because you absolutely need the money.
Yeah, that's my whole kind of philosophy with the whole medicine thing as well, that like it's just so much more fun when you don't need the money because then going to work is what you do for fun rather than what you do for your salary. But again, that's a very privileged position to be in, to be able to say that. But I think in fairness, like I wanted to get to that point from the age of 18, and I've spent the last like 15 years of my life doing online businessy things in various degrees, and it's only in the last few years that it's actually been successful. So I never want to give anyone. Yeah, exactly.
So you took that risk, and it's cool. Like you don't like brag about this or anything like that, but I'm sure you have your own goals of helping the world and being charitable and things like that. And it's really cool to be able to do things like that, and know that you're going to be able to do more by continuing to work and continuing to grow, your business or your portfolio or whatever. It gives you more opportunity to help other people too.
Yeah. So a few of the things I wanted to ask you about. There's or the chat seems to skew fairly young from what I can vaguely see looking on the side. One question I've always sort of semi wondered about is if, for example, we're talking like if for example I were talking to, let's say, a 15-year-old or someone between the ages of like 15 and 18, for example, and they had like $1,000 to invest. I'm not sure if I would actually advise them to invest it in stocks and shares. I would instead probably say, hey, make that your like book fund and just buy all of the books that you ever want to read, and start with these and use sort of invest in your own skills, invest in leveling up your skills, because the return on that is so much greater than the return that $1,000 in stocks are going to have. To what extent would you echo that advice?
Yeah, I mean, I agree. I would say 100%, right? Like, I don't know that I would ever tell a 15-year-old or whatever to invest in stocks. It's like,
What did you say about my Lego?
nothing, buddy. I'm
No,
finished.
what did you say about my Lego?
Nothing. I didn't say anything about Legos. All right, you want to say hi and then go finish putting your Legos together?
Hello.
Say hi.
Hi.
How are you?
We have a dog named Mommy, and she's a pit bull, and she's 9.
Okay. All right. Love you.
Thank you.
Yeah, I would tell them to do that. Go do something interesting to you. Like, don't even worry about the stock market. Learn about it. You don't have to start investing when you're 15. I tried to start a gaming business, a game server rental business when I was like 15, because I played Counter-Strike Source, right?
Yeah.
And I did that with some of my grandma's money, and it completely failed, and I wasted like $800. That was probably a better experience than investing in stocks, I guess, unless I would have bought Apple back then, right? Because then it'd be it'd be worth like billions of dollars right now. So yeah, I echo your advice.
Nice. A couple of other questions. So, what's the difference between Motley Fool and 7 Investing?
Oh, geez. We respect the Motley Fool, and all of us are from there in one way or the other. But there were just some things that we wanted to be able to do differently, and that we wanted. One of the things we're really proud of is we have a very, very, very small marketing budget. Most of the stuff we do is just organic out there on Twitter, or we have a podcast or YouTube or whatever. And then we, a ton of our subscriptions come from word of mouth. We have a referral option where members can go in and share their link out, and then they get, for everyone that signs up, they get a free month. We've had members get 30 free months because they've signed up 30 friends. And then the other thing we're really proud of at 7 Investing is that we have one product. It's $17 a month, and you get 7 recommendations every month. That's the only thing we have. We're not going to upcharge or anything like that. And so that's a little bit different than the Motley Fool model. And they're a very successful business. We have a history of working there, and we have a lot of friends there. So, we respect the Motley Fool and what they're doing. We just wanted to do things a little bit different.
Okay. On that note, let's say hypothetically, like an extra, I don't know, 100x people were to sign up to 7 Investing and start using your recommendations. Would that, to an extent, invalidate the recommendations, or is that not really how the stock market works?
If I think it would have to be like millions.
It would have to be like stupidly large amounts for it to actually make a difference.
Yeah,
Okay.
I mean, okay, so not a difference at all. The entire market, or a company, large cap companies that are like very commonly traded, it's very hard for any service, even a service that's as big as the Motley Fool, that have been in business for 20 years with, however many subscribers they might have. Very hard for any service to make an impact on the stock price, like a subscription service.
Yeah.
If you get to, very, very small businesses and penny stocks, which we don't recommend penny stocks at all, there is the chance that people can manipulate the stock price with some type of a service or something like that. We don't ever recommend penny stocks or companies like that, so I'm not concerned at all. There's a chance if we had millions of members that some of the companies we recommend that aren't as big as Amazon or Apple, the price could get moved if everybody went out and bought it. But if that ever happens, it would be a very good problem as a business to have, and we would definitely have to be mindful of it. But we're nowhere close to.
That's not something we need to worry about. Okay. Good.
Yeah.
Fantastic. Great. Final question I wanted to ask you is that so if what would be the most compelling reason for someone not to sign up to 7 Investing or equivalent service? Like, assuming the $17 a month is like doesn't make a difference to someone who wants to invest, I don't know, thousands or tens of thousands. Like, what's a reason not to do it? Or is it because at the moment it feels like a no-brainer, and I feel like there's always like a few, like an anti-7 Investing person, what would they say?
Yeah, definitely. So there's a lot of reasons not to subscribe to 7 Investing or like any service. There's a lot of reasons like not to watch your videos or sign up to your course. And again, like, I'm not trying to attack you here. I'm trying to like make it similar.
Yeah.
I'm trying to make it relatable, I think is what I'm trying to say. I could say I like Ollie's content, but I'm not going to pay for his YouTube course because I can learn all that stuff on my own.
Yeah.
So a reason not to pay for your course is because you can learn all that stuff on your own. A reason not to sign up for 7 Investing is because you can learn about all of these stocks on your own, and you can go to Twitter or any of these different platforms and see people talking about stocks all the time. And the stock market has gone up and done really well. So like, you could do really well without 7 Investing. Our process is that we provide, detailed reports, and we do have some members only stuff. And again, I'm like really trying not to come off as like,
no, sure. You don't need to worry about it. It's all good.
We think our value is the environment we have as a team, where we have team calls where we pitch our recommendations to each other, and then we ask each other questions. We share those videos with subscribers. We do full detailed reports on each of our recommendations. They're like 3-page reports, and we provide those to all of the members. We have subscriber only calls where they can ask questions and things like that. And then we transparently show all of our returns, which the return is public. Everybody can see it. You can't see the specific recommendations, but if you just go to the recommendations tab, you can see how well they're doing. That's all public, and we hold ourselves accountable. So I think those are all reasons to subscribe. But if you love doing it and you know what to look for in companies and you're successful on your own, like, that's amazing. Invest. Like, I just love sharing the knowledge with people. Like, you could listen to our podcast and our YouTube channel and get all the information you need probably, and never sign up for our service. And I'm sure people do that, and that's awesome. That's great. But we could have a very successful business if just the people that want to support us, like, sign up and support us.
Yeah, that's a nice way of thinking of it. That's how I think when it comes to selling, I've been historically very anti just selling anything, because it's always felt to me as like I feel like I'm begging for money. But actually, the switch I've had in the last few months is that I'm not begging for money. Like, 99% of my stuff is free. If you want to pay for it, then by all means you can pay for the premium stuff, but I'm not losing any sleep over the fact that some people choose not to do it, because it does not matter to me in the slightest. And I feel like that just makes it a lot easier to be like,
Yeah, and I agree with you 100%. It's kind of like the Gary Vee thing, right? Like, give away 99% of your content and then charge for the 1%. And there's a lot of people that can't or won't or don't ever want to pay for your service, and they don't have to. And you could be very successful still. And the same thing with us is like the 1% or 0.5% that do, we could still be very successful with that,
Nice. Perfect. That is all the questions that I had. Let me see if we've got anything in the chat that was particularly.
I saw somebody's asking if I withdraw a percent of my portfolio to live off of. I don't, because I still work and stuff like that. But if I was, that's something that I would start thinking about if I didn't have any income or anything like that. And if I was in that situation, then I would not have any money that I needed to withdraw in the next like 3 years. I wouldn't have any of that invested, because there are bear markets and things like March of 2020 happen. So if I was relying on my income, I would have a much bigger, or relying on my portfolio to live off of, I would have a much bigger amount of money in savings than what I do.
Cool. We have 6 minutes left. If you've got another 6 minutes, where we can just like literally take random questions from the chat.
Yeah, I'd
so
do whatever. Like, is there anything? Have I been unclear on anything, Ollie? Like, is there anything?
No.
Just call me out on it. You won't offend me. Like, what? Do you have any questions?
No, I don't. I was writing them down on my little notebook as we were going along, and I've crossed all the ones that I had. Oh, the only final thing that I was interested in, but I didn't really want to get into the weeds with this. Are what sort of things do you look at in your checklist when you're identifying companies?
Yeah, great. So okay, what industry is the company in?
Let's say tech company.
Like,
I see. Okay, that's what you're asking. Got it. Okay, continue.
Yeah,
Please.
Yeah. First thing I ask is, what
Yes.
industry is the company in, and does it seem like that industry is going to get larger? So let's go with the industry you were going to say. You were going to say tech company.
Yeah, I was going to say tech companies that people have heard of.
Tech companies that people. Sure. So let's talk about. Let's use whatever. We could use Amazon, right?
Yeah.
So Amazon sells stuff online, right? They're in e-commerce. They also have this massive cloud services business that's growing really well, right? So right there, it's really clear to see that the cloud computing industry and e-commerce, it's not going away. Those are very real industries. And if you Google projections for the growth of e-commerce or projections for the growth of cloud computing, it's very easy to find free reports that project them growing by billions of dollars in the future. So those are industries that I'm willing to invest in, right? And so then the things I look for is what type of management does the company have? Is it still, I really like to invest in founder-led companies that are led by the person that started the company, which Amazon happens to be, Jeff Bezos, right? So then I like to look at the history of the management team, right? So what have they done before? What have they done since managing the company? Do they have fraud in their history? That's a big red flag for me. But once you kind of pass the management check on your checklist, then I look at their products and what products do they have, right? And so for Amazon, I mean, they have all kinds of different products, but it's very easy to understand that Amazon makes a lot of money from e-commerce.
Yeah.
They make a lot of money from subscription cloud computing services that people pay them for. And they actually make a lot of money from advertising. And then there's like other different buckets of money too. But and this is where it takes a little bit of diving deeper, right? So then you have to go to the company's webpage, Amazon. And if you just Google Amazon Investor Relations, you'll get to their investor relations page. And every quarter, the company provides an update to the SEC that shows the performance of the business, right? And so that's where you have to dig in. And I'm just pulling it up right now.
Yeah, I'm looking at it as well.
That's where you have to dig in.
Oh God, this is really long. Bloody hell.
Yeah, so if you click on October 29, 2020, you see Amazon.com, announces third quarter report, right? So operating cash, the first thing you can see here, operating cash flow increased 56%. I could stay for another hour and talk about the definitions of these things, but we don't have to go into all that, but that's a good number, right? 56% is pretty good growth. The other thing I pay attention to revenue growth. Is revenue growing? Because a lot of businesses are built off of revenue. That's what they invest in, and that's just sales. That's how they grow their businesses and invest, and everything is kind of stems from revenue growth. Net sales increased 37% to $96 billion.
It's not
What's
bad.
up, buddy?
Is this,
I'm helping with Legos.
Does this go all the way on?
Nope, it just goes like that.
Like
that on the end right there.
go like that?
Yep.
Can you do it, please?
Yeah. I'm helping with a Lego. There, just like that.
Thank you.
I'll come help you in a few minutes, okay?
Okay.
So that tells you two things, right? Amazon's sales are growing at 37%. Off of $96 billion in sales. So Amazon isn't a business that, and it's obvious now, but they have a very reliable business model and a very real business. If they were growing 37% off of $1 million in revenue, that's a lot different than growing 37% off $96 billion in revenue. So you dig into their quarterly results and you start to see what is the health of the business. and I want to see growing, like revenue growth that's around 30%. This is just what I look for. Revenue growth that's 30% or higher. And I like to see, in a business that's smaller than Amazon, I like to see that actually growing faster quarter over quarter or year over year. So
Okay.
if it's a company that's smaller, I want to see it, say it grew 30% in 2019. I want to see it growing 40% in 2020, because that's how businesses grow larger and larger. And then I like to look at their revenue. Is it recurring revenue? So does it come with Amazon? A lot of their revenue from their cloud services is subscription. People subscribe to that and they pay every month. They don't have to go out and build new vehicles and sell them like Ford has to do, which costs a lot of money. So is the business in an important industry? Does it have good management? Are sales growing? Are they getting more profitable on a quarterly and annual basis? And then what is their revenue made up of? Is it like Apple, where they have a lot of subscription services, and Amazon, where they have a lot of subscription services? Or is it like an airline? Or is it like an auto manufacturer, where they have to build a new car every time and then sell one of those things to then have money to build another? I tend to avoid businesses that have high capital expenses, like airlines and car manufacturers and things like that.
Okay, perfect. That makes a lot of sense.
And there's more to it, but like that's the basics, right? Is you start to learn what makes a good business, and then you dig in and study those things.
Yeah, awesome, cool. Thank you. You've answered all my questions, and now I'm turned on to the idea of individual stocks. So I'll be dabbling through 7 Investing later today and thinking, how do I actually start doing this? So yeah, thanks for taking the time. This has been a lot of fun.
Yeah, and I'll give you a checklist that's in PDF format that people can just take and use to start to look at businesses on their own. And so that way it's not just me talking, but like it's actual like lines on a page that says, hey, here are the things that I look for when I'm looking at business. Because I feel like I didn't do a good job like sharing that entire checklist, and I want to share something.
Oh, sure. Yeah. If you've got a link or something, I'll put it in the video description thingy afterwards that people can check out.
Okay.
But yeah, thanks for taking the time, and have a great rest of the day.
Awesome. Same to you. Thanks a lot. I really appreciate it.
See you later.